Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Cardinal stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 23 billion market cap. They're trading at $90 a share and they have 254 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They generate lots of free cash flow each year, peaking in 2022 at 2.7 billion. It's almost 2.4 billion this year. They completed their 2023 fiscal year. Their fiscal year ends June 30th. Net income is the profit or loss on the income statement. It's revenue minus expenses. Really big negative in 2020, probably due to asset impairments. Also a negative in 2022. It is positive in 2023, but not nearly as high as their free cash flow. We'll go through their financials in more detail so we can try to understand better why their net income is so much lower than their free cash flow. Revenue is a sales for the company, and that goes up a ton from 153 billion to over 200 billion. The first time they broke through 200 billion. That's a crazy amount of revenue for their market cap because their market cap is only 23 billion. If your market cap equals your revenue, that's generally a good thing. And their revenue is way above their market cap. So just based on the price to sales ratio, it's extremely undervalued. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 43 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $41 billion. We divide that by 250 million shares. And we get a calculated stock price of 161. They're trading at 90, so they're trading at a 44% discount. It's a pretty strong buy according to the model. When I put together my model, my valuation was well above $200. I did adjust the assumptions a little bit because I thought that was way too optimistic. Even in a stressful scenario, it still seems pretty undervalued. Maybe we'll get a little more color when we look at that balance sheet. There are 9 companies in the same industry as Cardinal. If they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount on CapEx, 469 million, more than the median average. We can't look at their debt to equity ratio. It appears they have negative equity because their price to book is also NA. And in order to calculate price to book and debt to equity, we need the equity from the balance sheet. And if it's negative, you can't really calculate it. They pay a pretty good dividend, 2.2%. Paterson's 3.1%. McKesson, the largest company in this industry, is only 0.5%. They generate a lot of free cash flow. They rank 3rd in market cap, behind McKesson and AmerisourceBergen. We saw earlier their net income is really low, so their price to earnings is pretty weak. But a solid price to free cash flow, it's below 10. Which is a lot better than number 1 and 2 in this industry. Most companies in this industry have a really good price of sales. They have really slim margins, these companies. Like supermarkets, really razor thin. Cardinal only converts about 1% of their revenue into free cash flow. I'm actually the controller for a small medical manufacturing company, and they do a lot of business with Cardinal. Cardinal generates a lot of revenue, over 200 billion, a lot more than the average. They're still growing. Their 5-year annual revenue growth rate is 8%, above the median average. They just released their 6/30 results. They beat earnings and revenue. The expected earnings was 148. They reported 155. So that means they beat expectations by almost 5%. And they beat revenue by 1.5%. They reported 53.45 billion. That's just for the quarter. The second quarter of 2023. Which is this company's 4th quarter of 2023. So now 4 quarters in a row, they beat earnings and revenue. Before we go through their financials, I'm going to show you some highlights from their press release. 4th quarter revenue increased 13% when you compare it to the same period last year. It was 53.5 billion. Operating earnings of 137 million, but they had a net loss of 25 cents per share. Operating earnings are higher than net income on the income statement. After operating earnings are other income and expenses, taxes. The 4th quarter profit for their pharmaceutical segment increased 12% to 504 million. Their profit in their medical segment was 82 million. Their operating cash flow was 2.8 billion, free cash flow of 2.5 billion. I usually look at GAAP numbers when I look at their financials, but free cash flow is not a GAAP number. It has to be non-GAAP. Their 2024 EPS guidance is raised to $6.50 to $6.75 from $6.45 to $6.70. That should have helped boost the stock price a little bit. Let's look at their 10K. This is for the fiscal year ended June 30th, 2023. Because they're an oddball company, their fiscal year ends mid-year, not end year. I guess even more oddball is ending on 3/31 or 9/30. It looks like they only have one security issued. Their common shares, ticker CAH. If a company has preferred stock or debt issued, then it's usually on the first page of the 10K or 10Q. Let's go through their income statement. They show us 2021, 2022, and 2023, the full year. Revenue of $205 billion. That's billion with a B, as Mr. Wonderful would say. Let's get a breakdown of this number so we know what it is. The company distributes medical products. So if a hospital needs needles for a surgery, they may get it from Cardinal. And most of their products are pharmaceutical, 190 billion. That's up 15% from last year. Last year was 165 billion. Medical products is down, it's 15 billion. It was almost 16 billion last year. That's down 5%. Their total revenue is up 13% when you compare it to 2022. Over 95% of their revenue is in the US, 200 billion, 4.6 billion international. But I could almost guarantee nearly all their products are made outside the US, mostly in China. Because a company can't survive manufacturing in the US, it's way too expensive. You'd have to charge so much money, no one would want to buy your products. So you have to go international. China's a really common one. They have really slim margins. Their cost of revenue, all the expenses directly related to generating the 205 billion are 198 billion. That's the cost to buy the products. It also includes the cost of payroll and lots of other expenses. So their gross margins are 6.9 billion, up from 6.5 billion, up a little from 2021 of 6.8 billion. So 2021's margins are much higher than 2023. Very similar gross profit, but a lot lower revenue in 2021. Because the way you calculate gross margin, it's gross profit over revenue. I calculated their gross margin in Excel. In 2021, it was 4.2%. Gross profit 6.8 billion over revenue 162 billion. That's 4.2%. 2023, 3.4%. So that means in 2023, they converted 3.4% of their revenue into gross profit. And it kind of makes sense. Inflation has gotten really high the past couple of years, and it eats into companies' margins, especially companies that already had slim margins. Companies that have really high margins, like specialty jewelry companies, they're not nearly affected as much by inflation. Companies like this in supermarkets can really struggle. Let's look at their operating expenses. Distribution SG&A 4.8 billion. That's up from prior years. This section talks about distribution SG&A. It's up 6% from 2022, 4.6 billion to 4.8 billion. The increase is mainly due to inflationary impacts related to transportation and labor costs, higher operating expenses including higher costs to support sales growth and incentive compensation. These increases were partially offset by the beneficial impact of cost savings measures. Lots of fluff. They really like to spin things. They pass through lots of impairments, 1.25 billion. This is when you decrease the value of an asset on your balance sheet and pass through a loss onto your income statement. Last year, even more, 2 billion. That's why their net income was negative in 2022, this $2 billion impairment. If they didn't have this impairment, they would have had a net profit of 1 billion. Instead, they had a net loss of 900 million. They still managed to have a net profit in 2023, even with the 1.2 billion impairment. A big help was a $300 million recovery in litigation. Since this number's in the expense section and it's negative, that means it's positively impacting their net income. You see right here in parentheses, recoveries. If it wasn't in parentheses, it would be a charge. Like last year, a $100 million charge in litigation. In 2021, a $1.1 billion litigation charge. And we could search the 10K to find out what the recovery is. But let's just move on. So their EPS for 2023 is $1. That's earnings per share. The way you calculate that, you take your net income 261 million, over their shares outstanding, which happens to also be 261 million. So that gives us $1. I'm sure if we went out further to further decimal points, we would see it doesn't equal exactly the same number, but it's pretty close. It rounds to $1. Last year, they had a net loss of $3.35. Before that, they had a net gain of $2. And they are buying back stock. In 2021, 292 million shares outstanding, 2022, 279 million, and this year, 261 million. It really helps to have positive free cash flow because the company can buy back stock and in that case also pay a dividend. And I'm pretty sure I know why they have negative equity. I'm not sure if you figured it out yet, but we'll see here on their balance sheet why they have negative equity. I'm referring to the very bottom of the income statement. That's why they have negative equity. But I'll show you on the balance sheet when we get to the equity section. The first section of the balance sheet is the assets. They have 34 billion of current assets. Their current liabilities are also 34 billion, so their current ratio is slightly above 1. They could cover their current liabilities with their current assets, but it's really tight. They have 4 billion in cash, 11 billion in receivables. That's how much money other companies owe them. 16 billion of inventory. They always have lots of inventory on hand. 2.4 billion of prepaid expenses. They have 6.1 billion of goodwill. Last year they had 7.6 billion. So that's the impairment, the goodwill. Their goodwill went down 1.5 billion. Let me show you on the income statement where the impairments are. The impairment for 2023 is 1.25 billion. But we saw their goodwill went down 1.5 billion. So they must have had a gain on the disposal of assets, which reduced that 1.5 billion. If we dig a lot deeper, we could figure out where that gain is, but I don't think it's that relevant. So their total assets, 43 billion. In their liability section, they owe other companies 30 billion because they buy on credit. They have 4 billion of long-term debt. They also have 800 million of long-term debt, but this debt is due within 12 months. So it's the current portion of long-term debt. I'll show you the detail of the debt so it makes more sense. They had to borrow money. They borrowed 4.7 billion. And here's a breakdown of all their borrowings. They took on debt that's due in 2024. It's due next year. So they might have took on that debt 5 years ago, 10 years ago. I'm not exactly sure when they took on the debt, but it's due next year. They owe 764 million and they're paying a pretty low interest rate, 3.1%. Last year, they owed 779 million on this debt. So throughout 2022, they paid down 15 million on this note. This note has a 3.5% interest rate, also due next year, 400 million, and then on and on. They have debt going out to 2047. They also sold debentures, and that has the highest interest rate, 7%. Debentures are unsecured debt that's backed by the company that issues that debt. So Cardinal issued this debt, and they received $124 million, and whoever bought the debt is receiving the 7% interest. Any company can issue debentures. Microsoft may pay 4% interest on their debentures because they're a low credit risk. A company like Zillow may pay 9% interest because they're a little riskier, but it's unsecured, so there's nothing backing the debt if the company doesn't pay. So of this 4.7 billion, 790 million is due within 12 months. So probably all this 764 million and part of this 404 million are due within 12 months. The rest is due beyond 12 months. Let's look at their equity section. They raised 2.7 billion from issuing stock. They have an accumulated deficit of 530 million. This number is a sum of all their prior net incomes minus the sum of the dividends they paid out. But they bought back nearly 5 billion of their own stock, which is why they have negative equity. They have negative 3 billion of equity. If they didn't buy back this stock, they would have positive equity. Let's look at their statement of cash flows. The way you calculate operating cash flow, you start with your net income or net loss. And that's a really volatile number for this company because they do lots of asset impairments. But operating cash flow smooths things out. You can see their operating cash flow is fairly steady. 2.8 billion this year, 3.1 billion last year, 2.4 billion before that. Of these 3 years, the biggest loss was in 2022, 930 million. But they generated the most cash flow that year because of that $2 billion impairment. That's a non-cash item. We add it back here. They also had a big boost in accounts payable. This means they bought on credit. meaning they bought products from other companies but didn't pay for it. So it's a cash inflow. When they actually pay for the products, it'll be a cash outflow in that accounting period. It looks like the past 3 years they're buying a lot on credit. In the investing section, they spent $480 million in PP&E. These are investments in property, plant, and equipment. They only spent $10 million in acquisitions. In their financing section, it looks like they're paying down debt, $579 million. Last year, $885 million. They paid out over $500 million of dividends, and they bought back lots of stock, $2 billion. Last year, $1 billion. That's a good way to pump up their stock prices, to buy back stock. Investors really like that. They've done a lot of stock splits, 9 of them. The most recent one was in 2001, 22 years ago, or 3 for 2. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $24,000 today. That's a 9% return, a 136% total return. Let's look at the stock on Simply Wall Street. Its last price, 91, market cap $23 billion, down 1% in the past week, up 29% in the past year. Let's learn a little more about the company. They sell healthcare products all over the world, in the US, Canada, Europe, Asia, etc. They provide customized solutions for hospitals, healthcare systems, pharmacies, ambulatory surgery centers, clinical laboratories, physician offices, and patients in the home. They operate 2 segments, pharmaceutical and medical. In their pharmaceutical segment, they distribute branded and generic pharmaceutical, specialty pharmaceutical, and over-the-counter healthcare and consumer products. They also provide services to pharmaceutical manufacturers and healthcare providers. For specialty pharmaceutical products, they also operate nuclear pharmacies and radiopharmaceutical manufacturing facilities. That's a mouthful. They also repackage generic pharmaceuticals and over-the-counter healthcare products. They also offer medication therapy management and patient services to hospitals, other healthcare providers, and payers, as well as provides pharmacy management services to hospitals. The medical segment manufactures, sources, and distributes Cardinal Health branded medical, surgical, and laboratory products. These include exam and surgical gloves, needles, syringes, and sharp disposable products, compressions, nutritional delivery products, wound care products, single-use surgical drapes, gowns and apparels, fluid suction and collection systems, urology products, operating room supply products, and electrode product lines. They also distribute a range of national brand products, including medical, surgical, and laboratory products. They provide supply chain services and solutions to hospitals, ambulatory surgery centers, clinical laboratories, and other healthcare providers. They assemble and sell sterile and non-sterile procedure kits. Founded in 1979, headquartered in Ohio. They have a bunch of risks: large one-off items impacting financials, those are the impairments, high level of debt, negative equity, dividend of 2.2% not well covered. Here's a stock price since 1990. It had a really nice run-up from 1990 to around 2001. It was at $76 a share in 2001. Then it was below 30 by 2009. If you bought it in 2001, you would have had to wait till 2014 to get back to where it was. It broke through $90 for the first time in 2015, and then it fell to about $40 in 2020. And it's up more than 100% since that time. It's trading on its all-time high, above $90. Actually, last month was its all-time high. It has come down a little bit in the past few weeks. Simply Wall Street is even higher than me. They're at 202. They say the stock is 55% undervalued. 14 analysts priced this stock at $96. They say it's 6% undervalued. Their trailing 12-month revenue in 2012 was $106 billion. It fell to $90 billion in 2014. And ever since then, it just kept going up from $90 billion to over $200 billion currently. And the forecast for 2026 is $250 billion. And I think there's a good chance it's going to hit that number. Here's their debt the past 11 years. In 2012 is $2.9 billion. It peaked at over $10 billion in 2017. They probably did a big acquisition in 2016 or 17. That's why it got so high. And they've been reducing their debt ever since then. It's down to $4.7 billion. You can see their equity was positive from 2012 to 2021. Then starting in 2022, they had negative equity, and it seems to be getting more red. And this green line is their cash balance, and they almost have enough cash as their debt. So they're not doing that bad, even though they have negative equity. Starbucks and Boeing have negative equity, and those are healthy companies. They do pay a higher dividend than the industry. The industry is 1.6%, they're 2.2%, but their payout ratio is 200%. Their dividends are double their earnings. But if you strip out that big asset impairment, that goodwill impairment, it won't look this lopsided. In 2013, they paid $1.10 per share in dividends. That's for the year. And they pretty much raise it every single year. From 2018 to current, the increases have been pretty minimal though. But the forecast is for them to pay $2.37 by 2026. And you can see their yield is all over the place because the yield is pegged to the stock price. It was highest in 2019 at 4.4%. The forecast is 2.6% by 2026. The CEO's salary is $700,000, total compensation $3.9 million. He's pretty new as CEO, less than 1 year. In the past 12 months, there's been 2 insider buys, 2 sells, but the buys were only for a small amount of shares. The sells were much larger. 89% of the company is held by institutions and 10% by the general public. Their biggest shareholder is Vanguard at 13%. Invesco owns 1.3%. So if you own Invesco stock, you have exposure to this company. Their employee count was 34,000 in 2013. It peaked at 50,000 in 2018. It's currently at 46,500. And their ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Buenos Aires, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.